All right, everyone. Well, welcome to the REIA Now update, the first of 2023. I can't believe January is almost over. So all of those New Year's resolutions, you guys better be getting to those. So today we're going to be hearing from our favorite constituent of Washington, D.C., Mr. Charles Tassell. Give us any updates that he has. And then, of course, our favorite guy in the notes arena, Eddie Speed, is going to be talking a little bit about what's going on in the market. Some forecasting, what's coming up, and there's going to be some really important updates and some good information that we know Eddie's going to be giving us as well. I wanted to share with you guys, as most of you guys know, I'm here in South Florida, Miami-Dade, Broward, and Palm Beach counties, and my company is Florida Homeowner Solutions. We have a data department, and we use a couple national platforms and some local platforms and software programs to pull from public record. And we compile public record every single week as we keep an update on how many foreclosures are happening in our market in South Florida. And I was sharing this information with Rebecca and Charles and thought that I'd share it with you guys that we were seeing an average starting in 2020. There was a lull, obviously, because of COVID. And then we'd start to see in each county maybe 30 new lis pendens, which are foreclosure notices that were filed for people going into foreclosure. In 2022, we saw that each county had maybe about 50 of new lis pendens each month, so about 150 every single month between the Tri-County area. Between November 29th and now, that number has doubled. We just pulled about 320 new people going into foreclosure. And we reach out to, on a monthly basis, a little over 7,000 homeowners that are facing foreclosure. And we speak directly to hundreds of homeowners every single month. And the general consensus is that the majority of foreclosures that we're dealing with now, people that we're helping get out of foreclosure, are mostly from loan modifications that were done in 2012, 14, 13, 14, with escalated payments, with ARMs for their loan modifications. So we're getting into the same rat trap that we were before. I've seen articles, and you guys probably have too, that Bank of America is coming out with another product now of maybe no stated income, lower credit scores, and there's going to be adjustable rates of mortgages, and we're going to get into the same issue. There's a lot of loan modifications still being done now that will have the same ramifications. They'll have adjustable rates of mortgages for a couple of years. So we're just seeing that spike in foreclosures, and I don't know if that's going to translate to every market, but just keep your eye out. So with that, I want to turn it over to our Executive Director, Rebecca McLean.
Thanks, Ryan. We really appreciate you being here with us today. As Ryan said, it's our first one of the year, and we hope to kick off a very informative year for you. So make sure you stay tuned with us throughout the rest of the year. He mentioned that we have both Charles and Eddie on today, and very, very timely because of the issues that are coming forward, both legislatively and all of the major changes in the market. So with the wave of change, you either ride it or you get crushed by it. So we're excited to hear what Eddie has to say about that today. Just to let you know, we will be covering some topics, both financial and legal today in both of these presentations, but we are not lawyers, attorneys, or financial advisors. So if you have major questions, please make sure that you get the advice of a professional, preferably a professional that is local to you and that can answer your specific questions. We are a nonprofit trade association. We've been around about 40 years now, and been out there to protect, to promote, and educate real estate investing to the public. We have over 120 local associations, and some of the major things that people are excited to join for are the legislative updates, the information updates, but we also have some really great programs like the one we have with Home Depot Pro, who is our sponsor of the broadcast today. We have special programs for investors. It includes 20% off at the register for paint, some rebates, and some other exclusive programs for our members. You can get those benefits and others by joining your local group. If you're curious about the local group in your area, you can come to our website at nationalreia.org. You can come to this front page, indicate that you are an investor. When you click on that, it'll ask if you want to find a local REIA. If you choose that option, it'll bring up a map of the US, and you can choose the group that is closest to you. So please make sure that you reach out and join those associations so that they can benefit you. Additionally, keep up with us. We have a monthly call, our REIA Now call on February 17th. We'll have some tax strategies, which are great here at the first of the year before you get ready for your April 15th deadline, or May if you are a corporation. And we have an upcoming winter conference in February, just to talk about some of the changes in investing strategies, things that you want to be aware of that may help you in your investing business. But for now, I'm going to turn it over to Charles, who can let us know what's going on and what we need to be aware of legislatively. Thanks, Charles.
Thank you, Rebecca. That was very kind that people want to join for the legislative update. That was wow. As compared to the bottom line and actually making sure you have a bottom line. But I guess if you get legislated out of business, you don't have a bottom line either. So that's part of it. Most of you have heard me over the last 2 years talk about the regulatory side of things, and we've seen whether it's been EPA, HUD, a variety of different departments moving forward with some different regulations. FHA is moving forward with a variety, some of which actually might be helpful if we start talking about modular homes and the ability to do some chattel loans and such and move that forward. However, there's been discussion going on, a bunch of chatter, and finally the Housing Coalition actually was able to meet with the White House, and there's been some efforts because of, if you remember back when the eviction moratorium went away, we got very motivated in working with the Housing Coalition as a group, kind of put the kibosh on that being extended by Congress. Since then, the White House has looked at other options that they can move forward. Since they can't seem to get something through the legislature, they go the regulatory route. So a couple of ideas that are coming forward, and depending on where you're at in the country, you're going to be like, that's it. Other people are going to be like, you've got to be kidding me, they're doing this. And the idea is this is going to be landlord tenant based from a federal perspective. So I'm not sure what the justification will be. There will most likely be a lawsuit at some point, but there's some general discussion points. A couple of the key ones are a 5-day grace period on rent. So if you've got contracts in place, you might just start thinking about updating them to make sure you get a 5-day grace period. Some people have a 2-day or a 3-day. Some people required much longer than that, but at least a minimum of 5-day grace period on rent. That's probably one of the things we'll be seeing soon. Another one is a 30-day notice for rent increases. I typically do 60-day myself just to give people a heads up. If you're not doing too much of a rent increase, you're usually not going to lose people on them. But again, it's always a risk. The White House is asking for a 30-day notice on it, but they are asking for 60 days on notification if a property is going to be sold. Now, how you're going to do that and still have a closing in time, I'm not sure. Sometimes it works, sometimes it doesn't work out, and we don't always know until we're actually going, hey, we're actually sitting at the closing table, we're actually closing. Okay, now I know it's actually going to occur. So I'm sure you've all been through deals like that where we're not sure until the last minute. So I'm not sure how we're going to actually comply with something like that. Again, these are kind of the initial regulations that look like they're going to be coming out of the White House, possibly through HUD, possibly by executive order. They're not telling us that part of it yet. There have been some other pieces that have been discussed and maybe held off for now. We'll probably see several of them come through HUD. And what we're looking for is probably going to be some best management practices on eviction moratorium issues or eviction diversion processes. And that diversion process, if you have a good program in your community, please let us know about it. If there's a project that works well, it might be underfunded, it may not be enough people to do it, whether it's with a courthouse, whether it's through magistrates, or if it's through a nonprofit on the side that helps, mediate, or let's face it, there's some organizations that help fund and cover the cost, and that makes the problem go away in the first place. So those are some things we're going to be looking for, capturing those kind of best management practices from our perspective that we see are actually effective, not just that hold up or delay an eviction process and that really don't solve a problem. So expect more to be coming out on that side of things. But if you are aware of a project or a program in your area that works well on evictions, whether it's diversion or whatever, please let us know on that. My email, charles@nationalrea.org. Please send that information to us. Give me a heads up on it. I would greatly appreciate it. The other thing I want to mention to you is, speaking of DC, we will be going to DC March 28th to 29th and going up to partner with NAA and NMHC, that's National Apartment Association and National Multi-Housing Council. We will be going on the Hill. Right now, it is actually going to be open. The halls of Congress will be open. The White House, not so much. Good luck getting in there still. That's pretty well shut down. And even when it was open, that was a more restrictive process. Literally, just so you guys are aware, I have had people ask, each congressional office is only given like 1 or 2 passes, sometimes daily, sometimes weekly, depending on what's going on. So you've got to know well in advance if you need to get 3, 4, 5 people to go through, you want to do a tour of the White House. Your congressional staff may be able to help you do that, but that's difficult. So I would not bank on that side of things with the White House yet for tours or anything, but we will be going up to Congress. We will be able to go into the halls again and visit with our congressional leaders. So those of you who are interested, please let us know. Reach out to Lori, Lori@nationalrea.org, and we'll be, again, the 28th and 29th of March. So with that, that's kind of where we're at legislatively. I will mention to you, most legislatures are either in session or getting up and going, whether it's a short session, long session. If they've got short sessions, please don't allow them to go to long sessions. As Mark Twain says, nobody's life, liberty, or property are safe while the legislature is in session. So bear that in mind. That's kind of where we're at on the legislative front. And if there aren't any questions, what we'll do is actually get right into the meat of the matter today. And again, we are privileged and honored to have Eddie Speed with us today. I was just down at NoteSchool recently. It was end of October, 1st of November there, and Eddie has a great program, well-respected industry leader, and had the honor of marching the halls with Eddie on many different occasions. So greatly appreciate his support and his integrity of supporting an industry. There's a lot of people who will make money off an industry and leave. Eddie pours back into the community. He pours back into the industry. And I really just want to say thank you, first of all, for that. And thank you for everything you've done, Eddie.
Thank you. Well, it is great to be here. It is great to see some old friends and meet some new ones. So I told them before we started the meeting today, I said, guys, the state of the industry is not going to be, it's going to be a lot different. And I think the point was made, you know, people that buy properties or notes or distressed assets in any way, when things change and the market turns down, this should be our opportunity. So I will tell you personally, I've made a lot more money in, you know, distress markets, down situations than I ever did in the best of situations. I'm not wanting bad for people. It's just, you know, that's just kind of what it's turned out to be. And as I think I go through this today, I'm making a statement with information that we've gathered. So the statement is this is what the market is. So I'm not trying to make the market sound better than it is or worse than it is. I'll start out by saying this. Charles was at Note Expo. That was our trade show, and Charles was there. And Charles, you heard the gentleman that did the keynote address. And his name is Kay Thompson, and he's CEO of a company called Waterfall. He has $30 billion under management. And they hire an analytics firm, and they pay a couple of $1 million a year to that analytics firm to project rates and trends in the market and market conditions, real estate market trends and predictions and stuff. So I try to stay off of Facebook when I'm trying to figure out what the market's going to do, and I try to call people like Cade. So I may be in conflict with some of how you guys see it today, but I will say that I believe I'm consistent with how, as Kate says, our company makes billion-dollar bets. And I'm consistent, I think, with how the big guys that are making bets in the business are seeing it. And, so I got a lot of slides. I'm going to go quick. And Charles, feel free to interrupt me. And if something comes up that's in a chat worth doing, and then we'll just kind of circle up the end. But I'm going to sort of roll through this quickly because I don't think we need to spend a huge amount of time on any particular subject or slide. So let's see here. First of all, I don't know if you guys realize this, but credit card debt is way climbing up. And that really is a reflection of after people kept getting a check from the government that they're living on credit cards. And so a big concern out there about that. And let's talk about housing. Well, we are looking at several things that are turning to be, I guess you would say, alarming. And that is that the number of houses being sold is dropped dramatically. And we have just under 1 million houses under the market. And you should say low inventory should equal high demand. Well, let me tell you something. We have the weirdest market I believe I've ever seen. And I've discussed this with a lot of what I believe are industry experts. We have an incredibly low supply, but even a lower demand. So, the inventory housing is dropped, but we have a lower demand. And this is a big subject out there, and this is delistings. These are people that had properties on the market, and they've taken them off. And, there's a lot of speculation about why that's true, but I think clearly that you do see a yo-yo effect if you look at it, but I think that the prediction is that the delistings are going to continue. Basically, I think they don't feel like they have a place to go. They have nowhere else to go. Here's the good news. This is the equity, and this is the debt. And if obviously you'll look in here, and this was the 2008 debacle. So that's when things got inversed. And so the good news is people have equity, and all these delinquent loans. The sad part is they can go sell their house and pay off their mortgage and have some money left. But I think a lot of them are not going to do that. I think a lot of them are going to ride it to the end. And, I think their house is going to end up in foreclosure. And we're going to see my friend that I just mentioned that did this keynote address. I had a conversation with him over an hour this week about what they're seeing. And he says non-performing loans and REO are going to become a big factor again. And that's what their company is predicting. By the way, they loan money to most of the entities that are buying distressed assets. So they're a funder of the distressed asset space. So they're following these trends. They also own about 1/3 of the reverse mortgages in the United States. So they're also in that side of the space. So the good news is that these people have equity. There's a way out. This isn't 2008. So kind of forecasting where we're going. Market Watch says prices will fall in 2023, but affordability will be the worst since 1985. Even with reducing prices because of rates, affordability is going to be the worst it's been since 1985. Now, if you're me and you're a creative finance guy and you're a note guy and stuff, this is incredibly good news, right? So I don't want to mislead you. Like, I'm looking for something that tells me the market's doing this because this is what we really know how to shine and do well in. But it is a market condition, and it is going to affect a lot of people. So, by the way, I don't know if you remember this, but Cade's prediction on the drop in the market this year, it was exactly that number, Charles. He predicted 8%. Now, if you're from Denver and West, you don't need to be convinced of this. You're already convinced because those markets generally have been annihilated already. And some of those markets are down, like literally 30%. But, and that's if there's going to be micro markets that don't have a hit and so forth and so on. But we are looking at values rolling backwards. Once again, what is our business? If you're a real estate investor, if you're a distressed note buyer, if you're a distressed real estate buyer, well, this should be the market where traditional real estate realtors aren't as successful and people like us become more successful. This shouldn't be bad news for us, but it will be different news. And I don't know. Fox is making a pretty aggressive prediction here, and that is that U.S. Suffering from second biggest home price correction since post-World War era. I'll be honest with you, I don't think we're anywhere near 2008. I've been doing, this is my 6th real estate recession. I started in 1980. I don't think that's really a truth. I think we're going to see a reset. And I think that if you look at the out west market and how we're east, I think we're a bit unrealistic of a drop in our markets. And if you live out west, you don't need to be convinced. So that's really, I think, a big variable in the market, but there's a lot of predictions out there. All right, let's talk hike in the meeting coming up in February. So that's a small rate hike compared to the others. But they're saying a rate hike of this, and then they're saying a rate hike the next. Now, here's what's interesting. They were naming the target range they wanted to get to 4.75 to 5%. Okay. By the way, they're talking for a rate decrease in the end of the year. Now, this is what this prediction said the Fed was wanting to do. I want to show you. And I mean, that tracks with kind of what we were thinking, another 50 basis points, possibly another 100 basis points. And then towards the end of the year, kind of cooling off a little bit. And then, oh, by the way, if you saw my prediction earlier, Powell said that housing markets will get reset. So he has complained on numerous occasions about one of the biggest fuelers in inflation has been the increase in housing market. Now, this came out, and this is where he's basically saying Fed rates are going up in February and making a prediction there. And there has been some rumbling that maybe they'll even raise rates a little bit more. Now, let me be clear about mortgage rates and the Fed rate. And I think this is probably common knowledge, but I just want to clarify this. Mortgage rates are generally tied to more realistically tracking 10-year T-bills. The Fed rate is the rate that the Fed charges banks, and it would be short-term interest rates. Generally, though, over the years, they will track. Sometimes you'll see an inverse for a period of time. I know mortgage rates dropped, I believe it was last week, and people are like, oh, yeah, look at that. Rates are going down. That's probably not realistic. By the way, just so you know this, you say, well, how could mortgage rates go down when the Fed keeps going up? And their answer is it's a bond. It's just people buying loans in the market, and you have a hedge fund that's sitting on $500 million and they need to get their money spent. And they're willing to accept a lower return to go get their money deployed versus sitting on dry cash. So usually that's what's driving the market, and that's usually why you see these gaps in rates. So a lot to be said about mortgage lending. Let me just tell you something. The loan origination industry is in significant turmoil. And the biggest wild card out there that really could change real estate even more than people are thinking is the mortgage industry becomes more unraveled than people are predicting. And I think that's a possibility. And let me tell you why I'm saying that. So when the virus started and 8.5 million mortgages stopped making a payment, mortgage originators that were taking these loans to Wall Street, mortgage-backed securities, they had essentially kissed the paper. They recoursed the paper to the bondholders. They basically said, if you don't get a check from the borrower, we'll make your check. Now that became known as the shortfall. Now, if you track people like Black Knight and Adam and those guys that we track on a daily, weekly basis, this became a big, gigantic piece of conversation, even around May and June of 2020. By the way, they were also responsible to cover taxes and insurance. So they had to not only make the mortgage payment to the bondholders, but they had to pay the taxes and insurance because they were obligated under Dodd-Frank. And so this was an industry that went about 18 months writing a check for $1 billion a week. And by the way, they borrowed about 80% of that money. So if you want to know why all these lenders that you keep reading about almost every other week, some gigantic lender cuts their staff by half, or somebody like Wells Fargo completely exits the market, or pretty much completely exits the market, or you want to know about, like they are sitting on a problem that when they lost their production and they lost the margin, the profit they were making on the production that they were doing, and their lost production like to the point of 60%. And you want to know they have some sins from the past that they could not stand things to go wrong, and things started going seriously wrong when rates went down. So just so you understand, I view that the mortgage lending situation is the biggest risk in the market. By the way, you remember me saying this is my 6th real estate recession? You want to know what has annihilated every one of those real estate recessions? Cost of capital or lack of capital.
Mm-hmm.
So this is, I believe that this is not talked about much. It is in the circles I run in, but it's not talked about much. And I just want to point out some facts. So we scraped this data, like literally this, in the last few days, and the elephant in the middle of the room is that right there. And we've seen mortgage rates more than double in a 12-month period, and it's the sharpest increase, statistically and as a percentage, and immeasurable time, and so forth and so on. A lot being said about that. Here's what most people don't talk about. And Ryan, this is a little bit contrary to what you were saying, but this is the Mortgage Credit Availability Index. This is what Mortgage Bankers puts out, and this is who can qualify for a mortgage. And so what this is these are mortgage standards. So if you look that when the virus started, which is really right here, if you go over here, we were about at just below 185. We clocked out at the end of the year at 103, which is here. So this is not what mortgages cost. This is who can get a mortgage. And so we have a credit crunch. Now, I'm sure Bank of America has a program that will fit some segment of the market, but this is a representative of the tightening of credit standards that has happened because of the virus. And you can see, like, everything to the left of this arrow here, you can look over here and you can see it's moved back and forth a little bit, but I don't think anybody believes that we're at a standard. And by the way, just so you know, that standard is 80 points different. We're at 103 and we were at basically 183. So that's an 80-point change in where we're at. And that's, if you want to say it another way, that's about 45% decrease in the standards of who can qualify for a mortgage. If you're doing lease options, if you're doing seller financing, this should be hallelujah, best news I've ever seen.
So Eddie, let me jump in here real quick. We had question clarifying what do the points mean, which is, I believe it's just the conglomeration of how this
Yeah, it's a grid, a scale that they built. Yes.
Right. So, but let me ask you this behind the scenes on this, and I'm hearing this from the home builder side of things as well, that part of the reason there's been an underdevelopment of housing over the past 10 years or so is because there were a number of people who were scarred, and I mean that business-wise scarred from 8, 9, and 10, lost businesses, and they did not want to get in that same situation where they didn't have a chair when the music stopped.
Yeah.
And how much of that do you think is going on in the CMBS world, the mortgage originator world? Same kind of situation where as soon as this sparked, I mean, I see that drop off dramatically.
Yeah.
And I think back to that early March timeframe of 20, and people went, and everybody just closed up and went, I'm closing down everything.
Well, I mean, the graph is what it is. The blue graph is just what it's tracked, right? And I can tell you that the day of, as you said, about, March and early April of 2020, and this is what we do for a living, and my shop's full of old mortgage people, right? And we're like, whoa. And I mean, it was dropping like a rock. But as you see, when the economy really recovered, mortgage underwriting didn't recover. And this is what I'm leading back to. I believe that the core of one of the deepest concerns in the market is, well, I'll tell you this. I have a high-level coaching student that is a mortgage lender that has been responsible for at least $20 billion in credit facilities to mortgage lenders for the past 15 years. He's in NoteSchool. I mean, now I call him up on the phone any day, and he's gone from kind of one shop to the other. And I don't say his name and I don't say what bank he's at because I'm trying to protect. He gives me great inside information, and I agree not to go say anything inappropriate about what he does in his day job or who he is, right? I called him before our summer event, and I said, I'm fixing to say that mortgage lending is at the cusp of potentially being the S&L crisis of the 1980s. And I want to make sure that's not overstating. You want to know what his response was? You're not overstating.
Oof.
So, I realized a little bit, I'm kind of the guy that's hollering fire in the theater, but I'm using this, as you said, as a give back. This is what we do every day. As you know, Charles, my shop is full of pretty savvy guys that came from big shops and study a lot of data. And my job is just to say, this is just what the mortgage industry is looking at. If you do what my guys have come from every day, you read the mortgage underwriter and the rags and stuff. That's just what's being printed. This is just what the market's saying. Mm-hmm. If you're in another end of the business and you're not looking at this every day, which I found that most real estate investors aren't, they're like, oh my God, this is just the market. So I called my friend this week because I wanted to get his response to this headline last week. Wells Fargo, once the #1 player in mortgages, is stepping back in the market. I said, what do you think of that? He goes, I think it's the shot heard around the world. I don't think there's much else to say. I mean, when the biggest player in the business exits the business, they see blood. And I know the counter arguments, and I know all this and that. I'm simply saying we've seen First American exit the market. We see Wells Fargo exit the market. We've seen the market condition because of this shortfall is they've run it out as far as they can. Charles, here's where I see is an additional risk. Mortgage lenders are very creative at hiding stuff on the books. They have a long history of it. It's called 2008.
Absolutely.
And I think there is a lot of blood hidden on the books. And I think as this stuff unveils, we're going to find a lot of distress that wasn't in the stats. That's what I believe. And Charles, if you look at 2008, isn't that exactly what happened?
That's exactly what happened. In fact, in 6 and 7, there were people who started to go, do we realize how much? And shh, don't say it. So
You know what? I have a chart to prove that. I have a chart to prove that.
Right.
That if you were paying attention, you could have seen the trend starting in 2005. All right. So loan originations, you want to know when we say their volume is down. I think this probably speaks volumes, because in 2021 they did almost $5 trillion worth of business. By the way, they were projected to do $2.5 trillion. When the numbers are now coming in, I think they did not hit their 22 prediction, and I think a lot of people think they're not going to hit this number. So if you got a friend in the mortgage business or the title business and they're crying the blues, it's just math. And I'm not flippant about that at all. Believe me, I've been on the other side of these markets, right? But it definitely is what it is. So all right, let's talk about investor properties, because really that's the biggest thing. If people want to know about the house flipping business, I would say I'm in real estate masterminds with probably 75% of the biggest 500 house buyers in the business. I'm in Boardroom, I'm in Collective Genius, I'm in Investor Fuel. I have good connectivity with a lot of the guys that really drive the biggest volume in the business. I don't know a single operator in the business right now that hadn't pretty much had their business annihilated, right? So it's been pretty drastic. And I think these numbers actually are really quite a bit worse than they're saying, because I know the biggest operators out there. And it's simply because of this. House flippers were buying houses and selling them to people for investment purposes. They were selling them to Wall Street, and they were selling to brand new people buying rentals that had never owned rentals before. What we call HGTV dreamers, right? And that market completely flipped. So now the guy's got to go sell to consumers because people aren't buying them for investment purposes, or if they are, that's the case. I asked my friend, he said, I told you about it. He said, I sent 200 REOs to a well-known iBuyer this week. He said they bid 30% less than they would have bid on them about 8 months ago. So they just have exited the market. It's just, when you replug the numbers in the spreadsheet and you change the yield requirements, it just changes the numbers. So that's pretty much the case. Another thing that I think is pretty telling here is this drop right here, which is really showing the drop in price and penetration in the market. In other words, they're just not buying properties. And I think that trend's going to continue. Listen, I've heard arguments the other way, and I could be wrong. This is now me giving a prediction based on a chart you're seeing. I think that chart is going to continue to be on the drop side. I could be wrong about that, right? Another thing that we saw that went wild during the virus is luxury homes. It was easier to sell a $700,000 house than it was a $170,000 house. And everybody's been around a long time. They're like, that's just weird. Well, believe me, that red line represents a pretty significant drop in luxury homes. And the gray line here is the non-luxury, and it's represented as well. But I think the red line kind of screams, right? So these are sales of luxury homes, not prices. These are sales. All right, let's talk about non-performing loans. Let's talk about the surge in the market. So Charles, you mentioned that there were people that could have looked in the market in 2005 and 2006 and figured out there was a problem growing, right?
Absolutely.
Okay, blue represents defaults, green represents foreclosures, and black represents REOs. So really, if you would have looked at the market literally in anywhere in this area in here, you should have been able to see there's a gigantic problem brewing. By the way, I want to remind you guys of something. We've had at least 1.5 million mortgages in default for 3 years that nothing has happened to them.
That's correct.
Now, what I thought was interesting is taking this chart. By the way, look at when the virus started.
Mhm.
Now, I guess, Charles, those loans just went away.
Well, it's one of those things, though, Eddie. I want to see that little section right there. Then when you stand it up on its end, suddenly it goes like this and spikes through the roof.
That's it.
And that's what we're going to see.
All right. So I broke this chart down a little separately. Look at the trend that you could have started seeing through 2006, right? Now look at the trend you could have started seeing from 2006 to 2008. Could you have heard the train coming down the track if you'd have been paying attention? Then look at when the real problem was, which was after 2008. And that's when most of the inventory got washed through, and then it kind of leveled out. And then, of course, all of a sudden, the virus came along and this inventory went away, but it didn't go away.
Mm-mm.
Okay. And Charles, let me just tell you that you take this part right here and you move it over here. And these are called legacy loans. These are loans that are delinquent before the virus started. And then you add to it a whole bunch of loans from COVID. And right now that number is about 1.5 million. And this is why all the records and people are saying what Ryan said, what he said, and headlines every week of, foreclosures are doubling and foreclosures are tripling. All it is inventory that they finally are foreclosing on. That's what it really is. It's not like it's new stuff. They didn't get delinquent 6 months ago.
Nope.
So this is inventory that has been coming down the pike. I've been saying this so long, Charles, I feel like it's a broken record, but what I have been saying took a lot longer to happen than has happened, but it definitely is happening. And so once again, this is just data. This is from Black Knight. Those of you are familiar with it, it's like there's about 1,635,000 loans. Now that's 30 days delinquent. I want to be clear about that. That doesn't mean every one of these loans are going to end up in foreclosure. You want to know my prediction? It's going to be 1 million. Because the gap between loans that are 30, 60, and 90 days and the loans that are excessively delinquent, the excessively delinquent pile is deep and long, and it's over 1 million loans. So that's kind of the reason I'm saying that.
So Eddie, we had a gentleman on last time. Actually, you're familiar with him, George Newberry, and we were talking about the idea that there's going to be a lot of these foreclosures coming, and most of us won't see them because the banks are real discreetly trying to hide from DC by just showing them off their books as quickly and quietly as they can, because they don't want to be called the big bad banks again and get called in for another Dodd-Frank style rewrite of legislation.
Yeah, so my last slide is showing what happens to loans in the market. So the loans in the market here basically are like this. So the banks pile up these loans, and their typical pattern is they sell them, and they sell them to hedge funds. And so they'll sell them to my friend that runs this big shop, right? And they take loans and they sell some of these loans into mortgage-backed securities. But there's always a lot of these loans that don't fit the securitization model, like a reperforming note that got delinquent in the virus, and now he's paying again, and the guy's actually doing good and paying again. And so all of a sudden, if there's not a closing statement when the loan was originated 12 years ago, it can't be securitized. And so we buy a lot of loans like that. And we buy them. These are like all $1 billion plus trades. And then we end up with a piece of these trades and end up in our little bucket. And that's kind of people like George Newberry, who we know very well, and us and other operators. That's how we end up getting this stuff. And it's both reperforming notes and non-performing notes that end up in this bucket. We are closing more non-performing notes this quarter than we closed in the last 4 years.
Are you seeing a increase in the default rates? Let me ask you this. Are they releasing the information on the default rates? Because that's where I've seen it like flat, just like the graph you showed. It's flat. Nope, nothing to see here. Don't look.
Yeah, I have we've got a number of people that, work with us, some independent contractors and people that are employees. They all came from big box shops, right? Bob was from Bayview. Charles was at American Home. Kevin Moore's been with a lot of big shops and stuff. We got a lot of guys that come from that world, and they're kind of entertained by getting up every morning, reading some mortgage underwriter magazine or something. That's not my entertainment, by the way. I just want y'all to know that personally, yeah, there is an increase in new delinquency, but this old delinquency, it's just there, and they've been begging and pleading and doing everything they could to get these people modified, and they've modified, they believe, all they can, and now the rest of them are coming over the mountain.
Right.
So don't be surprised if you're seeing all these news and foreclosures are gone up 4 times and whatever and stuff, and it's like, well, sure it has. It's pent up inventory. It's been sitting in the closet. So it's not a shocker. It's just what it is. So just little shameless plug for just a second. That is how you reach us. We have Jeff Watson, who you guys know well. Jeff Watson actually does some speaking and training for NoteSchool, and his primary focus is doing REIAs. And so if you would love to have us come speak to your group, we'd love to do that. And we are teaching people how to do creative financing. We're teaching people how to buy distressed assets and buy performing notes of these reperforming notes. So yeah, it's kind of like it was back in 2011 and 12. And so we've got that in motion, and we're deep in the space. So we're trying to study the market. So I want to be careful that I'm not just saying things that, oh yeah, well, Eddie, that sounds good for NoteSchool, but it's unrealistic. So let's see, I'm going to try to exit here my share so that there you go. So you guys can.
So Eddie, along those lines, let me ask you a question. There's a question that we had about repayment of loans and such. And I want to take it from a little bit different direction. And
Okay.
If everybody will pardon me for being momentarily a little crude, but part of when it comes to the economics, looking at the global economics, there's a degree to which the US dollar is the best of the junk, the cream of the crap is what they typically say. Yeah. So what we're seeing is outflows from other countries putting money into the US. I go back to The Economist in 2012 saying that single family homes in America are the best and most stable investment in the world. And that was kind of a floodgates opening to see funds coming in from around the world. So a lot of the groups that are out there, the larger corporations, they've got, kind of to your point about the bond side of things, they've got money that they have to get invested, and they've got to invest and put it in there. How much of that is going to keep driving the cost, maybe not the value, but the cost of housing, and keep it from doing the drop that it did in 9 and 10?
Well, once again, I really don't. I'm not looking for 2008. You guys. I mean, 2008 was just a wild, crazy scenario,
right? And
that was driven by the fact that they had there was a excessive oversupply. There's seemingly an undersupply. Now, this pent up inventory of 1 million foreclosures is inventory that I don't see people calculating. I listened to Bruce Norris, I listened to John Burns, I listened to some really smart guys, and I know them, and I ask them, like, why are you not throwing that number in there? And I have my own opinions as to why I think they're not doing it, but they acknowledge, you're right, I don't have that number in there, right? One thing about Eddie Speed you can say, right? I don't care if Fannie Mae loves me or not. I'm not trying to be a popular guy. I'm not trying to be unpopular. I'm just trying to tell the truth is the way I see it. So I'm friendly with a lot of guys that daddy gets some saying over them, and I know them and I like them, and I think they're really smart guys, but I think some of the messaging gets muffled. Mm-hmm. And I'm not muffled. you know, Rebecca knows me, you couldn't muffle me anyway, but the truth of the matter is, you know, I'm just, and I knew I was going to say something not good today, but I just wanted to show you data. I mean, like it's a little hard to deny. It's just data facts. By the way, we scrape all this from usually the same sources that you guys have 100% access to. Housing Wire, DS News, Black Knight, Adam. These are all just, I mean, like, it's not like we're paying $10,000 a month to go source data. This is all just public information. And so I think we're going to see a slippage. I think it probably is going to be worse than what they're predicting. And the reason is I think there's mess on the books and the mortgage originators that we're going to go, oh, wait a minute, we didn't know about that. That's where I think the bomb could be because of. Do I think it's 2008? I don't think that's going to be the case.
Right. And I think your point on there, that unraveling, and some of it's got to be unraveled. And especially when you start getting higher default rates in the CMBS than they're expecting, you've got to break some of those out.
That issue over there, that's a way big problem. But that's not residential. That is a way big problem.
Well, yes, that's so everybody in the office side, there's a lot more trouble. If somebody offers you an office property at a discount rate, be careful.
Yeah.
So
yeah, I don't, the commercial side there is a gigantic pinup inventory of modified loans that have not gotten cured, or loans that they've put on the ice and trying to figure out some kind of workout scenario and stuff. And it's so that the CMBS stuff definitely is, and you can go do a lot of research on that, and you're going to find I'm not being dramatic. It's fairly public.
Yeah,
there's some gigantic problems.
Well, and the key difference there is something I think you mentioned earlier, the underlying principles. I mean, we're not talking going into 2020 and even 2023 now that we don't have the ninja loans, the no income, no job application.
Yeah,
there were documents that went through, people researched, they went through, have typically somebody who's actually paying the bill. And they were actually paying at some point versus what we had in 2006, 7, and 8. So substantially different. And it will be interesting to see, even as we get into later this year, how it works out. Now, Eddie, you mentioned Adam data. We've got Rick Sharga is going to be on in July for us and kind of give a follow-up, because we're expecting, especially by the time we get into the summer and seeing numbers change, and who knows where the Fed goes if they do the half point like they say, or 2 quarters, I should say, and kind of slow it down and feather it in, and if that's enough or not. And that's going to be interesting to see. So
I think no doubt the inflation factor is a difficult card to call. And I want to leave you guys with this. I'm really, I see this as nothing but opportunity, and I want you guys to see it as opportunity, right? There is a point in the market where the market reaches an old man told me this in the 80s. I asked him, I said, why is the market doing this? This is before Texas blew up in 1986. And I said, why is the market doing this? And I was a young guy in the business in my early 20s. And he said, son, it's called a bigger fool theory. He said, you're like buying a piece of property looking for a bigger fool than you.
Yep.
And so there is a market that we just lived with. That's a bigger fool market. That's all that it was. It didn't make economic sense. There was no reason that actually was a truth. And it was just a bigger fool market. And a lot of people made a lot of money in that market. And you did really good, and your real estate went up in value. So I think that, anytime we see that, there's usually something behind it. And so now it's going to be an opportunity to really, be a smart, informed buyer, right? I'll give you one caution flag about commercial. And our friend Thomas that typed in the chat board there, Thomas, you are correct. The biggest risk is resets. About 1/3 of multifamily and storage facility loans and generally commercial real estate, the syndicators put together, about a third of those loans are tied to variable rates. The reason they chose the variable rate is because they could get a non-recourse loan and a higher loan to value. That's why they did it. And those loans are due for resets. And a reset that when they modeled it at a 4% rate, that could be an awakening in the market. Just something to watch for.
And Eddie, it's interesting you mentioned that. I was in a meeting till about 8 last night with a couple bankers and CPAs discussing that facet, and they were literally running the numbers going, you know, if the interest rate climbs this much, but the rents are climbing this much, can those resets survive or not? And there were a number of areas where it was, you know, maybe not. And as soon as you're in maybe not, those are large corporate that are going to be selling very quickly. So it'll be very interesting to see how those go. But
well, let me just tell y'all, if you've been through less cycles than me, this is my 6th, and I'm still kicking. So we're okay. We're going to be good.
that's right.
Just find the opportunity in it.
That's it. Fish in troubled waters, as it were. So, all right. Hey, Eddie, we want to say thank you again. Thank you for your insights. Thank you for great information you're bringing to us. Everybody take the heads up. This is, you've been informed. Now, what are you going to do with it? So with that, thank you very much, Eddie Speed. We'll give you a round of applause digitally here. Appreciate it. And then turn it back over to Rebecca and Ryan. Mr. President, what would you like to do?
Well, do we have any questions remaining? Did we get to everybody's questions?
I think we got the questions covered.
Yeah. Okay, very good. All right. Well, appreciate everything. Again, thank you, Eddie, for all the information. This is valuable to all of us, and everybody can be passing these on to their members as well. We have our quarterly leadership call on February the 15th at 2 p.m. Eastern Standard Time. So we will see you guys then. And thank you guys. Have a great weekend.
Thank you.
Bye-bye.